got that G, got my nullos. I'm just saying. You pull up to the scene, they be filled with jealousy. If a bitch get
stop
finicky, she gon' bring the energy. I hit a phone with a
3, 2, 1, action.
Dear light.
I got chills, then multiply.
So hello everyone, it's Harvey and I'm back for another video, and I hope you guys are having a good time. Welcome to my channel. How are you guys doing? Yes, welcome to another lesson regarding option trading. So today we'll be discussing protective put option strategy, and people are like, wait, what the is that? I'll try to explain it the best way I can. First, protective, that means you have an option to protect yourself. It's like having what we call limited liabilities, where if something happens to your business, for example, it doesn't affect your personal belongings, it just affects the business itself. Does that make sense? So that's how I can relate protective put option. Remember, put is when we put down the phone, right? So now let's get into it. A protective put option strategy is being long a put. A long put. That's the best way I can say it. So being long a put option while also being long the underlying stock. In other words, the investors with an investment objective of the capital preservation utilize the protective put option strategy.
We're gonna get into some technicalities here, because you know they always got to come with the receipt.
So, like I said, the long put option gives the investor the right to sell the stock at the strike price within a specified time, because puts, option trading, options have an expiration date, okay? So when the stock declines to 0, there is no more deduction from your portfolio. That's why it says protective put option. So it has a limited amount of loss. So if your stock is $10 and the put declines, it can only depreciate up to 0 of the stock itself. It will never affect the other stocks in your portfolio, okay?
This ain't no allegedly.
So if the stock declines, for this the investor pays a premium for the put option, which gives the right to sell 100 shares of a stock. The maximum upside potential for a protective put strategy is infinite, because if the stock appreciates, that means your opportunity to make profits appreciates. That's why they said infinite, as the stock price can potentially rise to any price, you see. But when the stock depreciates, it can only depreciate up to the point of 0. So the maximum potential loss is the amount paid for the long put premium plus the difference between the price. The premium, like I said, is called the advance payment you make for like a collateral, like I'm paying this just in case. So that is what we call premium, okay? Plus the difference between the price paid for the stock and the strike price, which means the agreement where you guys are like, okay, let's shake on it. This is where, if it gets to this point, then this put can be exercised or cleared, like your check clearing up, okay?
The is getting hot in this sweater dress. Let me turn on the fan real.
Therefore, a protective put option strategy requires a considerable level of risk tolerance. The break-even point, where you don't make profit or make any money or lose any money, okay, of a put option is the price paid for the stock plus the premium for the long put option. An investor who has a bearish outlook, bearish is when someone is like, I think this stock will not go up, it will always decline to 0, okay, anticipates that the price of the stock will decline to a certain, beyond a certain price by a set date, utilizes a protective put option. So a put is when the stock is going down and an investor is like, I think this stock will go down to this particular price, so I would use this option. For example, an investor anticipates that the stock price of stock A will decline in the next 3 months. The investor bought stock A at $11, while stock A currently trades at $10. He puts, or she, or they, okay, they purchase a put with 3 months until expiration with a $10 strike price that trades at $2. The investor buys 100 shares of stock A at $11 and later buys a put at $10 strike price with 3 months until expiration for a premium of $2, which is an advance of $2. The maximum potential profit is theoretically infinite since the stock can rise to any price. So now this is how it's calculated. The maximum profit is equal to the amount of profit increase in the stock price minus the premium, because this person has already paid premium in advance, times 100 shares will give you the amount of profit. Okay, when you read it out it sounds so weird, but let's put it this way.
Girl. Oh my God. Clearly you need to relax. Well, don't. Woo! Just sit down. Now, come on. All right, Vet, come on now. It couldn't have just kicked in like that.
Oh, Lord, my pressure.
So the maximum potential profit is when you buy a stock option puts at, let's say, $10, right? Now, if this stock goes down, when you buy a put, you pay a particular amount of money to buy a put. The buyer or the seller gets a premium because I am buying the rights that if this stock gets to this particular strike price, I would be able to sell that, because now I have, it's like renting a house from someone, okay, and then subleasing it to someone else. That's the best way to put it. I'm renting these stocks from this person, and then I can now sublet it out to someone else if it gets to a particular price that I have shook, with handshake on this, like, hey, this is it. Okay, that's the best way to say this. Now, the maximum profit would be the infinite increase in the prices minus the premium that the person, the buyer, the seller had already gotten from me, times 100 shares. Maximum loss would be the premium paid for the put option plus the $1 difference of the stock price and the strike price multiplied by 100. This is how it's calculated. So maximum loss is equals to premium paid plus price of stock minus strike price of puts times 100 shares. So if it's $300, that means $2, which was the premium, plus the stock price, which is 11, which makes it 13, minus 10, which is the put option times 100. So the break-even point is $13, which is the purchase price of the stock at 11 plus the premium of 2 paid for the put option. The break-even point would be the strike price minus the premium paid.
Ooh wee, look what that money make a bitch do.
The break-even point is equal to the strike price minus the premium paid. Whew, that was a mouthful.
You've never been to heaven,
Y'all heard it, right?
have you?
The break-even point would be the point where you ain't making money and you ain't losing money. The strike price would be the price that you guys have agreed on the puts. Let me say the stock is at $10, right? I bought my stock at $13, but it has depreciated to, let's say, $10. I now put a strike price and say, okay, strike price for this stock is, this stock would not go down to $10. But the person who buys the stock from me, the option put from me, is saying no, this stock will go down below $10. Now we have that difference of $3, right? Now if it goes down below $10, I have no choice than to sell the stock, the option, the 100 shares. I have no choice than to sell the 100 shares to this person at $10 each. Meanwhile, this person has already given me a premium of $2 or $3, which makes it of $2 or $3, depending on where your stock is. Now, when that person gives me that, I'll keep that premium, provided the stock does not go below 10 or gets to 10. But once it gets to 10, I'm keeping the premium, but I have no choice now than to sell all that stock of 100 shares at the price of $10 to that person. Does that make sense? That's the easiest way to describe all this chart. So once I've sold that at that price, now the person who now has these shares from me can now hold on to that stock. If it appreciates to $100, that person can sell it at $100 and make the rest of the profit. But I, who sold this put, I will be making no money afterward. If stock A trades above $13 and beyond, the protective put strategy will be profitable. You see, but if stock A remains below $13, the most the investor can lose is $300. Good. Until the expiration date. The break even is $13, which is the $11 price paid for the stock plus the premium of $2. Okay, now if stock A price falls between 10 and 0 during the duration of this contract, the long put holder can exercise it, which means I, who bought the put.
This ain't no allegedly.
You see, if that stock falls below the strike price, I, who bought the put, would be able to make money. Okay, this is, yeah, and this results in the investor selling that 100 shares to me at $10 because I said no, this stock would come down to $10, and this person said no, the person who owns the stock is like, nope, this stock will stay above $10. Now I, who bought the stock, would pay the person who sold that option a premium, that is the $2, an advance payment. Like I'm holding this 100 shares in a contract with you. If it comes below or at $10, I have the right to sell that stock. But if it stays above, you can keep the premium because the deal did not work on my behalf. So the put option acts as an insurance from losing any more than 300 from the investment in stock A. If the price of stock A falls to 0, the investor is still able to sell this stock A for $10 a share. And if the investor, however, did not want to sell this position, they could sell the put option at a profit. However, if the stock price of stock A remains between 10 and 13 during the life of the option contract, the investor loses between 0 and 300. Okay, that was the best way I could describe it. Now let's break it down. This is a put option. If my stock is at $5 and this stock has dropped to 4, I'm like, I, who have 100 shares, would sell a put out, like, okay, this stock will not drop below $2 or $3. But if it does, anyone out there has the right to buy these stocks at that price of $2 or $3. Okay? Now, the person who buys this option that I have created or written out, if this stock, that person would pay the premium of $2 or $3, which is between 5 minus 2 or 5 minus 3. That's $2. I, who sold this put option, would hold on to that, provided that this stock does not go down to the $2 strike price we've agreed on. See? Now, I'm safe provided this stock is out the money, which means it stays above $2, which is the strike price. The person who is buying this option from me is praying for this stock to fall to $2 or below, because that way they will be able to take my stock from me that I bought at $5, what has depreciated to $2. Does that make sense? Now, more gonna be losing that. So if the stock does not fall to $2, I'll keep the premium, it's mine. But if it falls to $2, I'll sell the stock, still keep the premium, but now I'm selling my stock at a loss to this person. Now this person gets the deal. Okay? This person now who has bought this can either keep the stock or hold on to it or sell it, the put option. Okay? Or hold on to it and it appreciates after buying it from you, after the expiration date. Now they own the stock. So if it appreciates to $10, $20, they are keeping it. That's the best way to describe this, okay? I hope this helps someone out there. I had to break it down as much as I could. I love you all and I can't wait to see you guys soon in the next video. Bye guys.
'Cause I'm loving myself real good. Did you guys hear that? I'm scared. In a way that you never could.